So let's review how to create the statement of cash flows. As you recall, that there are three different types of activities that we need to identify in the creation of this statement. They are the operating activity, the investing activity, and the financing activity. As we talked about in discussions in class, there's a couple different ways in determining how to determine the three different types of activities, and I've found over the past that probably one of the easier ways is to take a look at the balance sheet. If you take a look at a balance sheet where we've identified our assets and liabilities and we've broken them down into its current and long-term components, if you take the changes in the accounts in the current assets, the changes in the accounts in the current liabilities, you basically have the information available to you to create or identify the operating activities section of the cash flow statement. If you identify the activities and changes in the long-term assets section of the balance sheet, you'll have the information in order to create the investing activities section of the statement of cash flows. And then finally, if you find the activities and the changes in accounts for the long-term liabilities, and in the stockholders' equity section, the common stock and the dividend sections, you'll have the information for the financing activities. Now, besides looking at the balance sheet, you might have to look at the income statement if you're creating the statement of cash flows, because the whole concept of the statement of cash flows is where does your cash come from, as well as where have you used your cash. Ideally, one of the most important places to identify or where you get your cash is going to be coming from your income statement, because your income statement is your day-to-day operations of your buying and selling of goods and services. So, when you take your revenues minus expenses, you'll get net income. And net income will be part of the statement of cash flows in the operating activity section of the statement of cash flows. Now, another way to take a look at the statement of cash flow preparation is to maybe take a look at a T account for the cash account. Now, here are some examples of some of the various types of things that may affect the cash account. Now, of course, what we did is we put this in a T account format so you can identify the debits and credits, remembering that cash is an asset. So on the debit side of this T account, those will be the increases to cash or the sources of cash. And on the credit side of the T account will be the uses of cash so that we can identify. Now, when we look at the specific transaction in the debit or credit side of this T account, you can ask yourself, how does this affect the balance sheet that we're showing up here? So, for example, if I look at cash received from customers, cash received from customers can either be derived from cash sales transactions from your customers or from the collection of accounts receivable. Cash paid for merchandise is where you have paid your vendors for goods and services, and you either paid those vendors through cash or you paid them later through accounts payable. Same thing here with cash paid from operations. Cash paid for operating expenses are typically things like utilities and rents and other type of expenses that are on a day-to-day basis, so therefore it's part of your operating activity. So is cash paid for your interest, because your interest is the payment of interest for where you borrowed money, but basically you've had the use of that money for your daily operations, so therefore cash paid for interest is considered an operating activity. And the same thing goes for taxes. Taxes are generated because of the profits that you have done on your daily operations, so therefore we would include that in the operating activity section as well. If you take a look at here, when you hear the term plant asset, you know that that's a long-term asset. And since it's a long-term asset, any changes in that long-term asset account, whether it be the sale of a plant asset or the purchase of a plant asset, such as over here, these two, whether it be on the debit side or the credit side, would become an investing activity. Finally, the last piece is the financing activity. And remember, the financing activity, as we showed up here, are the changes in the long-term liabilities, such as notes payable or bonds payable. and the common stock in terms of the issuance of common stock, or the repurchase of common stock in the form of treasury stock. Also, one other area is the payment of dividends to our shareholders. So therefore, when we look at this T account, you can see where we've retired bonds, or we've sold bonds, we've sold stock, or we've paid out dividends. Excuse me. Then finally, once you have broken this down, now you can create your statement of cash flows. When you take a look at your statement of cash flows down here, here's the first one. Remember, we had two methods. One's called the direct method and the other's called the indirect method. Now, the direct method basically shows what we just showed you in this T account. The cash flow from operating activities, where we now have identified the debits and credits of the current that affected the current assets and current liabilities, such as receiving cash from customers, the payments to our for purchase of merchandise, payments towards our expenses, our interest and taxes. All those items are under operating activities. Cash flows from investing activities were from the long-term assets section, and the financing activities are from the liabilities and the stockholders' equity section. Notice the format of this financial statement in that where we use dollar signs on the very first number in the columns, so we have it here and here, and then we use underlines and double underlines to note where totals are being made. Also in accounting, if you haven't noticed here, whenever you see a bracket, it means it's a negative number. So basically what we have here is the format for the direct method. Now what you find in the direct method is that is normally generally accepted accounting principle presentation on financial statements. Now a lot of companies find that this is sometimes a little more difficult to do because of the activities that go on in the cash accounts. Someone has to go through and accumulate all that information. So a quicker way, and a lot of companies tend to prefer to use it, is the indirect method. And now the indirect method is almost identical in terms of the numbers you obtain. It's just the format section in the operating activities is somewhat different. The concept is that net income is the primary source of cash being generated by a company on its day-to-day basis. So therefore, it uses net income as its starting point to determine the cash flow from operating activities. However, because net income also has several non-cash items in it, we have to adjust net income to reflect the non-cash transactions where we either have to add back or we have to deduct the values that are included in net income. So therefore, you start with net income, and for instance, depreciation is a reduction, as an expense, is a reduction of net income. So therefore, we have to put that back in because it wasn't a cash item. We do the same type of thing for other gains and losses that we've recognized in net income that had no cash effect. And then finally what we do is we take a look at the changes in current assets and current liabilities, and we reflect those as increases or decreases to cash. Once we get that, we'll get the net cash provided by operating activities. Now this value of net cash provided by operating activities, whether we use the indirect method or the direct method, should come up with the same value. The other two sections, the investing activities and financing activities, do not change between the two methods. So let's do this. Let's take a look at two examples that are in your textbook. So if you have your textbook with you, let's first take a look at exercise 12.7. Before we start on exercise 12.7, let's first take a look at exercise 12.5. 12.5 is a nice illustration as to the thought process that you have to go through as you look at the various accounts that are affected in the statement of cash flows. So let's take a look at Alberto Company for calendar year 2008, and we have three separate cases that hopefully you'll be able to identify or be able to figure out. But what I did is I set up on the right-hand side of your screen the T accounts for the various accounts that we're going to use in the three different cases A, B, and C. In case A, we're here to compute the cash received from customers. Now, the cash received from customers is typically coming out of, if all your sales or credit sales are going to be coming out of accounts receivable. So if I do a T account for accounts receivable, as in here in case A, where I have the beginning balance, the ending balance, and I know that accounts receivable is a current asset. So if everything is a credit sale, and credit sales are going to increase accounts receivable, there are going to be debit entries. And when I receive cash from my customers, it's going to decrease the asset, so therefore it's going to be a credit entry. So therefore I can go ahead and place the numbers in here. So for instance, the beginning balance for accounts receivable according to this case here says that accounts receivable on December 31st, 2007. Now remember, we're doing this for 2008. So the ending balance, in this case 2007, will become the beginning balance in 2008. So I'll go ahead and I'll put the $27,200 here. Now, the next piece of information that they give us is that we know what the sales are. So the sales over here is $515,000. And then we also know that our ending balance on December 31st, 2008 is $33,600. So if I know I started with $27,200, I'm going to add another $515,000, and I'm going to end up with $33,600. Therefore, in order to figure out how much cash I collected, I could create a formula here where I could say, take my beginning balance plus my increase, which is my sales, minus what's left over, which is my ending balance, and that would tell me how much cash I collected. So in case A, because I knew what my beginning my beginning receivables were, how much my sales, and how much was left over in my ending balance in accounts receivable, I could therefore figure out how much money I collected. Now in case B, where it says compute the cash paid for rent, what we're looking at is a liability account called rent payable. Now in rent payable, assuming that we're going to be, as we incur the rent and we're going to pay it subsequently, therefore in the liability, it's going to be a credit balance because liabilities are credit, normal balances are credits. So the rent payable balance on December 31st, 2007, once again, the ending balance in 2007 is the beginning balance in 2008, is $7,800. The ending balance is $6,200. And the rent expense, which is the rent that we've incurred but we haven't paid yet, is $139,800. So if that's the case, I can now figure out that if I started with $7,800 and I'm going to end up with $62 and my rent expense is my increase, I could create a formula here that says take my beginning balance, add in the increases, and then subtract what's left over, and that would show me how much I paid. Now the last one's a little bit more complicated because we're now going to take two concepts into play here. In case C, it says compute the cash paid for merchandise. Now with the assumption that all merchandise is purchased on credit, the first thing we have to do is have to determine is how much we purchased. So therefore, what we have to do is, if you remember this formula over here of taking your beginning balance inventory plus your purchases gives you your goods available for sale, minus your ending balance inventory gives you your cost of goods sold. If you recall in financial accounting, when we were talking about inventory, this formula is called the periodic inventory formula. So therefore, what I can do here is I can take my beginning balance inventory, and according to this problem, the merchandise inventory on December 31st, 2007 was $158,600. Now, we don't know how much we purchased, so therefore that's my unknown. So what I can now do is I can come back down here and I know what my ending balance inventory, which is 130,400. And I know what my cost of goods sold was. They tell me it's 525,000. So therefore I could work this problem backwards. If I knew what my goods available for sale was, and I'm going to subtract out my ending balance, therefore if I could create a formula that basically says if I took my ending balance of my ending inventory plus my cost of goods sold, that's how much inventory was available to me to sell. Because if I have available to sell, it's either I'm going to sell it or it's going to be left over. Now, if this is my goods available for sale, and I know what I started with, I could determine how much I purchased, because if I said the $655,400 is what I had in total, and I started with $158,600, the difference between those is how much I purchased. So I purchased $496,800 worth of inventory. Now, if all those purchases, the $496,000, was on credit, now we can go apply it to the T account for accounts payable. Now, according to this problem, the beginning accounts payable on December 31st, 2007 was $66,700. Now, accounts payable is a liability with a normal balance of a credit. So therefore, let's put $66,700 over on the credit side. Now we figured out the purchases from the number above. So that's $496,800. And we know that according to this problem, the ending balance for accounts payable is $82,000 even. So therefore, if I look at this problem, I know that I owed $66,700 when I started this period. I purchased on credit another $496,800, and I ended up with $82,000. I know that I had to have paid an amount to get to that $82,000. So let's create a formula for that. So we could say, take your beginning balance, then add in your purchases, and then we're going to subtract out what's left over, because if I took my beginning balance plus my purchases, that's my total liability, minus what's left over. The difference is going to be how much I paid. So what we're really doing is we're going back and trying to remember the effect of debit and credit entries in the various accounts depending upon whether it's an asset, a liability, or an equity account. So now we're going to move on to exercise 12.7. So let's go take a look at that particular problem. Exercise 12.7 is a continuation of exercise 12.6 that you were assigned for homework. In exercise 12.6, you were asked to do a statement of cash flows using the indirect method. In exercise 12.7, understanding that the statement of cash flows between the two methods, the direct and indirect method, are basically the same except for the section called the cash flows from operating activities. So therefore, this particular exercise is to show that we can show you how to do the direct method in terms of the operating activities. So let's go ahead, and I'm going to create it on this side of the screen. I'm going to say cash flows from operating activities. Now, the very first thing of cash flows from operating activities, as we go through just like we did on the T account for cash, is identifying that for the most part we're going to say is the receipts from our customers. Now, it would be really nice as if they had told us what it was, but we can actually calculate it. If we know if the calculation of the receipts from customers equals our sales, and in this case, because we have an increase in receivables minus the increase in receivables. So what I can do is I can say how much my sales were, which was $1,828,000. And I know that my increase in accounts receivable was $30,500. I can therefore create a formula that basically says take my 1,828,000 minus the 30,500, and I've got my receipts that I've received from my customers. Let's see if I can clean this up a little bit so we can at least know I can spell. Okay, so I now know that this number here is 179,500. The next one we want to look at is we can look at the payments for merchandise. Now, the payments for merchandise is going to probably come from our accounts payable. So let's create a formula. And what we can do is we can say equals our cost of goods sold plus the increase in inventory plus the increase in payables. Now, if you don't understand why we're doing that, take a look at that last problem that we did, exercise 12.5, to kind of show that in relationship between the payables and the inventory accounts. So let's do that. Let's put in the cost of goods sold. The cost of goods sold in this particular problem was $991,000. And we know that our increase in inventory is going to be 25,000 because that's what they gave us. And then we also know that our decrease in payable is 12,500. So then I can put in a formula that says take my cost of goods sold plus my increase in inventory plus my increase in payables. I get 1,028,500. Now, a payment is going to decrease cash. So therefore, we're going to put this in as a negative number, 1,028,500 as a negative number. The next one is the payment for salaries. Now, the payment for salaries also needs a calculation, so let's figure that one out. We can say the payments for salaries based upon salaries payable is going to be our salaries expense, because that's going to be the increase to the payable, plus the decrease in salaries payable. Now, once again, if you're not too sure why we're adding or subtracting those increases and decrease, Draw out a T account, just like we did in exercise 12.5. Draw a T account for salaries payable, knowing that the beginning salaries payable is a credit entry, the ending salaries payable is a credit entry, the salaries expense is going to be a credit entry, and essentially the payments for the salaries will become the debit entry to decrease salaries payable. So in this particular case, our salaries expense was $245,535, and our decrease in salaries payable was $3,500. So therefore, we can make a formula that says take the $245,535 plus the $3,500 to give me $249,035. So if it's a payment, it's going, once again, it's going to be a negative value because we're going to decrease cash because we paid it out of $249,035. Now the other ones hopefully will be a little bit easier because they're direct payments. There's no T account you have to worry about. For instance, rent. Let's do it in the same format. Payment for rent. Payments for rent, once again, is a negative value, is $49,600. And then last one, our payments for utilities. And once again, a payment is going to be a negative number, and it was $18,125. So if I go ahead and let's put just an underline here. So then we can create a formula, and we can say, oops, wrong one. Take the sum of these numbers, because they're positive and negative numbers. So therefore, our net cash provided by operating activities is $452,240. So what we do, let's make sure this is in good form. Such as that. So that's exercise 12.7. Hopefully you're able to see. Once again, the biggest calculations here are these three right here. If you're not sure, draw out the T accounts. It'll make it a lot easier. So let's go on to problem 12.3a. Once again, 12.3a. Problem 12.3a is a continuation of problem 12.1a. What I'm going to do here is we're going to do the direct method version, and also I gave you the shell at the very bottom on the right hand side for if we were going to do the indirect method. Remembering that the only difference between the indirect and the direct method is in the presentation of the operating activities. Now, to save time, what I did is over here, I've already computed the changes in the balances from 2008 and 2007 for the company. So what we can do is as we go through each one of the different items, we can talk about the various calculations that we have to make. Now, we've been kind of building up in all the other previous exercises. So let's take a look at the cash received from the customers. The cash received from the customers, as you recall, has to do with the relationship between accounts receivable and sales. So therefore, we can create a formula. And that formula is that we take into account our sales. And our sales down here, as it shows on the screen, is $582,500. So we'll put in $582,500. And then we're going to subtract out the increases in accounts receivable. And the increase to accounts receivable, according to my little calculation here, was $15,185. So therefore, I've got an increase to cash from the receipts from customers of $567,315. Now we can create a similar type formula for the cash paid for our merchandise. Now, as you recall um, from other exercises that we've done, is that when we look at merchandise, there's actually two pieces of this: the accounts payable piece, which is the cash paid for the merchandise, but actually how much merchandise did you actually have to purchase. So once again, we can use the formula that might be helpful, where we basically take into account the change because we're paying for the merchandise. So let's first figure out what the value is. And the value is, let's take our cost of goods sold. If we go down there, our cost of goods sold number down here is $285,000. So we're going to add $285,000. And then we're going to add in the increase to inventory. So our increase to inventory, so we're going to say plus, and we look for our increase to inventory. That increase to inventory is $23,856 over here. Also, we have to take into account the decreases in the payables. So therefore, we're going to add that in. And the decrease to payables, which is here, the $114,000 and the 53,141, which I can't highlight very well. And the change is 61,534. So what we want to do is 61,534. So we come up with 370,390. Now the cash paid for other expenses. Once again, we take our other expenses and then subtract out the decreases in the prepaid expenses. So our other expense, we can create a formula. Our other expenses comes out to, as we look down here, 132,400, so 132,400. And then we're going to subtract out, because it's a decrease in the prepaid expenses, the decrease in the prepaid expenses of $625. So we'll come up with $131,775. The cash paid for the income taxes, if we take a look, where do we come up with cash paid for income taxes? Of $24,250. So therefore, we come up and we can. Now we have to look at these because they're paid, they're actually negatives. So what we want to do is do a formula that basically says take the increase, and we want to take the decrease minus another payment minus another payment and we should come up with net cash provided by operating activities of $40,900. Now we can do the rest of this. The rest of this says the cash received from the sale of the equipment. The cash received from the sale of equipment of $11,625 comes from right here. Notice here the equipment cost was $46, accumulated depreciation of $30, and we only received cash. Notice we're only doing the statement of cash flows. We're not determining the gains or losses. So therefore, we're going to take the $11,625. Next, the cash paid for the equipment. Cash paid for the equipment, which is the new equipment right here, we paid $30,000 in cash. Even though it cost us $96,000, we only paid $30,000. The rest of it is into long-term notes payable. So because it's long-term notes payable, it's not considered a use of cash. So we'll put the $30,000 in here. But it is a use of cash, So put a negative. And therefore, now we can add these up. And if I take this number and subtract out this number, because it's a negative, we've used 18,375. Next, our cash borrowed from a short-term note. The cash borrowed from a short-term note, if we take a look at the information they provided, we borrowed $4,000 in D below, right down here. So we'll put the $4,000. Our cash paid for the long-term note, we find it on our sheet here, right below here is the $50,000. So we're going to pay this out, $50,125. The cash received is going to be an increase, so we issued stock. We issued stock over here, $20 times 2,500 shares. That's going to give you $50,000. Then finally, the cash paid for dividends. Down here, we declared and paid cash dividends of $50,100. So once again, we can now do a formula. And we can take all these and add it up. So we had a total use of $46,225. Our net increase or decrease to cash is if I have an increase over here of 40,000, a decrease of 18, a decrease of 46, I can create a little formula that just adds my positive and negative values. And therefore my decrease in cash was $23,700. Now, according to the problem here, my beginning cash was $73,500, so I'm going to put in here $73,500. And if I do the math and I take the beginning cash is $73,500, and then I add in my decrease in cash, so I'm going to actually subtract it, but because it's a negative value, I come up with $49,800 as my ending cash balance. So therefore, I know it's correct because this number, the $49,800, agrees to the $49,800 on the balance sheet. Now remember here, if we were to do the indirect method, what we would start with would be with net income. Then we'd have to calculate depreciation. So we'd have to subtract out the depreciation, or add it back in, and then we would go into account all the increases and decreases to the current assets and current liabilities. Bottom line is that this value right here, the net cash provided by operating activities, should agree to this $40,900 that we did using the direct method. Hopefully these couple problems that we've done for Chapter 12 will help you as you understand as we run through the statement of cash flows. If you have any questions, feel free to send me an email or ask questions in class as we go ahead and continue to review this chapter in the upcoming class.